Thanks for tuning into today's Talking Point. I'm your host, Nischal. Let's get in Nischal Maheshwari, Centrum, on this conversation to try and understand how do they as a house and how does he look at the current landscape in light of the fact that the texture of the market turned in the last day of the year. But we have oil on the boil, amongst other things, which could be some dampeners. Nischal, great having you. Thanks for joining in. It's been after 3 consistent months of a downtick, we finally saw, albeit marginally, a month in the positive, only to have the oil shocker coming in over the weekend. How does the equity landscape look currently to you?
Morning, Neeraj. I'm saying, see, that is what it is basically. You have so much uncertainty, so much volatility. Basically, things are as yet to actually stabilize. I think across the world, most economies are struggling to find a way through of all what has happened in the last 2 years, and especially, I think, inflation. Now, this is another cause for worry. Basically, if you have this kind of oil price increases, 5% in the overnight, basically, I think this is going to have a problem occur. So I think that's why we were not able to carry over from a very positive month end. And day one, basically, I think everybody seems to be worried again. So I think this is going to be continues to remain a volatile year again. I don't see anything changing dramatically overnight because inflation still continues to remain a big worry out there across the world. And everybody is still trying to stabilize, find stability within their economies. So I'm saying these are the oil producing countries basically certainly find that oil is, given that the demand is not very strong, oil is going one way down. So I think they are trying to stem their rot, but it causes inflation across the world.
And well said. And therefore, my question, Nischal, are risk assets like equities currently a blanket buy, or would you be very, very cautious? If you could, for your personal portfolios or your large client portfolios, would you recommend sitting on a bit of cash even now, despite the fact that we've now had 4 months of sideways to a negative performance?
Yes, I agree with you, Neeraj. There is no hurry in this market, actually. I don't see basically that the market is running away. There is everything positive happening across the world. We just come out from a big shock, basically, on the banking side. And that was, I don't think so. We have seen the end of it. Only retrospectively, one can say basically that was the end. So we have got two large banks going under, basically SVB and then Credit Suisse. So I'm saying, so given that we had this 2008 experience, so this time the US government didn't let the things go out of hand and they were able to stem the rot early. But I'm saying these are things basically which will create turmoil as we go along. And these high interest rates are going to create a problem across the world. In India itself, basically, we have another 25 basis point increase. It will be at least a decade high interest rate. US is now 40-year high interest rate. So at these high interest rates, basically, growth cannot be just expected to happen. So I'm saying that is what the big challenge is, basically, because we are still, the full transmission of these interest rates has not happened. And that's why it's not seeing its impact happening onto the growth. So that is what my worry remains to be. Till we pivot and we start cutting interest rates, I am not very sure basically that we are in a stable environment.
Got it. So hence the question. There's a lot of conversation around whether it should, if you are investing, should you invest in growth at reasonable price as a primary filter, or should you invest where the private sector spend or the government spend in India is seemingly creating opportunities of the profit pools or profit growth for the next 12 to 24 months? How are you going about deciding how to alter your portfolio?
So one, we have been suggesting, basically saying that at least the domestic story is more stable than the international stories. So domestic consumption is still more stable than the international consumption. So I'm saying basically focus only on domestics. And within domestic, we are saying consumption still remains to be the prime thing, basically, which has been a fair weather friend for long term. So I think focus on to the domestic consumption theme. Now there is another big pocket of government spending, given this is the last year before the general election happens. So I'm saying historically we've seen that a good amount of government spending happens basically in this last year of the term. So I think sectors which are focused there, cement, construction, these are two sectors basically one can look at. Again, I think the focus on the government side is basically trying to revive the capex. So I'm saying some of those capex stories can be looked at. But we have to see that capex story seems to have run away quite a bit in anticipation of that growth. So I think there one has to be very clear, saying that you shouldn't be looking at very high multiples as far as capex is concerned, because growth is fragile. I don't think so. The growth is given, and that is one thing basically we have to keep in mind.
There is, I mean, maybe because it was due to the year end or otherwise, but a bunch of construction firms, defense firms, as well as railway firms have gotten some very large orders in the last 15, 20 odd days, Nischal. These are multi-year orders, of course, and one doesn't know how the execution shapes up, but the numbers by themselves seem very large. Is this inviting enough, or because some of these pockets have shown erratic growth in the past, you would be cautious?
So as you know, basically, Neeraj, we had done a very large report historically in the defense sector, and the interesting part is basically out of whatever budget you see or whatever the allocation in the budget you see for defense, 75 to 80% goes into day-to-day maintenance of the defense forces. It's only 20-25% of that budget basically is available for you for what you say capex. So capex in these terms basically means spending into new arms and all that. And then these programs, so submarine programs also gets a part of the allocation. 1,020% of that at 80,000 crores is available to you every year as capex. Then you have those programs which have been for the last are getting executed. Each of these projects will get some amount of money. So yes, you have large order books basically, but at the end of the day, basically there is so much money available. So I'm saying the execution will only depend on that. So till the allocation in the budget for budgets, till the allocation in the for defense in the budget goes up, I don't think so. There basically you will have a faster execution. So yes, I think you have large order books, but I think that's true for Mazgaon Dock, Cochin Shipyard. All of them have 60, 70, 80,000 crore of order books historically. But the execution cannot be there basically because the government has limited amount of money to spend.
Well, that's such a vital point. And it might be great to do a study around, or maybe cite your report soon about the kind of order books that have historically stayed with these companies versus the kind of execution that they have done because of whatever the limited means available. Thanks for making that point, Nischal. The other question is cement. I heard you say that. Now, while until March the prices were subdued, we hear reports of price hikes being done for April. Ultratech's numbers for dispatches for the quarter 4 were also reasonably strong as well. What do you make of this? Is cement finally looking like a space which will deliver? Because hitherto it's kind of delivered in fits and starts and very, very selectively.
So I'm saying don't read too much into it. This is the best quarter for cement basically. And obviously on top of it, you have this, what I was mentioning earlier, that the last year of the government's term is always the strongest basically when they do the government capex. So I think you will see some good amount of offtake. That is what we have been seeing. But I think beyond 1 year, you are not sure actually how cement is going to pan out. what we are seeing is basically this huge amount of capex. Everybody seems to be now rushing into it. Basically, even though on a industry level, basically we are, I think, 60-65% capacity utilization. So I'm saying beyond a point, I don't see upsides in the cement stocks. But I think in the short term, you might be in for.
Yeah, slight issue with the internet currently, I guess, but we've mostly gotten the points covered with the Nischal Maheshwari. So maybe we'll call it a day on this interview. Nischal, thank you for taking the time out and being with us today. Really appreciate your time and look forward to have more insights from you in the near future.
Thank you.
And
Thanks a lot,
for tuning into this edition of The Talking Point.